Crypto technical analysis can sound intimidating at first, but think of it like learning to read a story the market is telling. Every candlestick, chart pattern, and indicator is a clue, revealing what traders are thinking and feeling. At its core, technical analysis is about understanding price movements over time. You're studying charts to identify patterns and trends. These patterns help you predict where the market might go next. It's not flawless, but it ups your odds. A common pain point for beginners? Information overload. Too many charts, too many indicators. Pro tip, stick to the basics first. Learn the price chart, moving averages, and support resistance levels. Everything else can come later. Let's talk candlesticks. These small symbols tell big stories. Open price, close price, highs and lows. Green or white candlesticks mean prices went up, red or black mean prices went down. Start there, it's Crypto 101. Now, candlestick patterns. Ever heard of the hammer? No, not Thor's. This hammer forms when a market is trying not to drop further and might reverse upward. Spotting patterns like this gives you an edge. Support and resistance levels are your map in the crypto jungle. Support is where prices often stop falling. Resistance blocks prices from rising. Imagine these as the market's invisible floors and ceilings. Moving averages smooth out price data to show trends. For beginners, the 50-day and 200-day are key. A quick, actionable tip: if the 50-day crosses above the 200-day, it's a bullish sign. Traders call it the golden cross. Then there's the RSI, Relative Strength Index, a tool that measures whether a coin is overbought or oversold. When RSI is over 70, the market might be too hot. Below 30, it could be a bargain. Here's where many mess up, relying on just one indicator. Rookie mistake. Combine tools like moving averages, RSI, and candlesticks to paint a fuller picture. Imagine trying to fix your car with only a wrench. You need the rest of the toolkit. Let's address FOMO, the fear of missing out. Crypto prices can spike suddenly, tempting you to jump in blind. I've made this mistake. Pro tip: don't trade based on emotions. Stick to your analysis and strategy. Keep emotions in check with risk management. Never put more into a trade than you can afford to lose. 1 to 2% of your portfolio per trade is smart. You'll thank yourself when you avoid huge losses from bad decisions. Finally, practice. Use demo accounts or paper trade before risking real money. Crypto moves fast and can feel chaotic, but over time, with the right tools and discipline, you'll come to see the market as more math, less magic.